I will go first, followed by Rizvi, followed by Rajesh, tech team, tech support. Good afternoon. My name is Ashay Vaidya. I head the product at Union EMC. First of all, thank you to all the participants who have joined to attend our webinar on the SIF product launch. The name of the product is Athaya Equity Long Short Fund, our first SIF product. Before I move forward, a quick update on the AMC. So we started in 2010, almost 15 plus years in the investment business. Uh, Today, if I have to give you an understanding of the AMC, we are live with 32 products, which completes our mutual fund suite on the equity, hybrid, and debt funds. Total AUM is around 28,000 crores, out of which 10,000 is in debt, and the remaining 18,000 is across our equity and hybrid schemes. Talking about the investment team, it's a wholesome team of 19 individuals headed by Mr. Harshit Patwardhan. So he's the CIO, a veteran in the industry with 31 years of experience. His qualifications: he's an IIT Bombay pass out, IIM Lucknow pass out, holds a CFA charter, and has worked with many top brands prior to joining us. So he was worked with JP Morgan, Edelweiss, and Greek Capital. Having said that, what was the case after completing 15 odd years, we had intended to start other business lines, which obviously includes SIF, AIF, and Gift City, with which in this journey particularly, we have already starting with SIF and AIF and Gift City to follow on. To help us take this leap, this journey, I have Mr. Rizvi, who heads the business on all the three verticals, which is SIF, AIF, and Gift City. And so he is there. He will also help us to understand about the SIF, the product with certain nuances. So Rizvi comes to us with a 20-year of experience across markets, across different, what do you say, strong names, strong brands where he has worked earlier. He has worked with Oyster Global, HSBC Investment, HSBC AMC, Invesco, ICICI Securities, and HDFC Mutual Fund. So for us, he brings on table both sides, the manufacturer as well as the distribution side. Along with that, I had the next esteemed speaker is Rajesh Enor. Rajesh is our investment lead for the SIF business. Again, a 2 decade plus experience on the investment side. And prior to joining us, he was head of equity at Prajana Advisors. More importantly, he was the fund manager for ITA Long Short Fund, and for a very long period of time. So, which makes him to be an important person in this SIF kind of a business, because again, it is a long short kind of a strategy. These are the two gentlemen who are going to spearhead the overall business, both on business as well as the investment side. I now request Rizvi to help us, make us understand the overall nuances of SIF as a product, because he also comes with the AIF experience selling as well as, creating a product. So over to you, Rizvi.
Thank you so much, Ashay, and good evening to all the participants. Indeed, a pleasure to have connected with all of you. And once again, a very warm welcome. Giving us a time out of your busy schedule on a Wednesday at 4 o'clock is commendable, and we really appreciate. What we will try and do over the course of next 25-30 minutes between me and Rajesh is that we run between the two of us through nuances of SIF. So let me give you some perspective on SIF as a category. Now, this is a category which has been introduced by SEBI effective December of 2024, which is when the regulations came in. The first product in the industry got launched about September, October of 2025. It's been about 6.5 months of the journey for the industry together. But while I travel across the country, I find quite a bit of, I would like to perhaps call it confusion, that our distributors are trying to figure out how do we place SIF in a client's portfolio. Because SEBI has given us three broad categories: equity, fixed income, and hybrid. Equity has three subcategories, hybrid has two, and debt has two. So that basically makes seven product categories within the SIF. And there are many competitors of ours who have already launched products across at least five of these categories. Right? There would be roughly about 12 to 14 strategies across all my competitors put together. The industry AUM is close to about 10,800 crore, roughly split between 7,800 and 2,900 crore between hybrid and equity. Yet there is a lot of confusion around what is it that SIF could do, what is it that other product categories like mutual fund, PMSs, and AIF could not do. So while many of you would be aware of many of these things, there are a few things that I would like to stress across. When we talk about mutual funds, PMSs, and AIF, we are primarily talking about long only strategies. In long only strategies, what the manager does is picks up good quality companies, waits for those good quality companies to increase their profitability. With increase in profitability and over the passage of time, those share prices of those companies tend to go up, and accordingly your returns are made. Though PMS could also possibly be having an opportunity somewhere in some specific instances to perhaps do some shorting, but in India, the PMSs that we have known are primarily long only. The difference between mutual fund, PMS, and AIF is only on how concentrated the portfolio is and what the sizes of the portfolios are. Mutual fund is for one and all, starts with basic 500, PMS is 50 lakhs, and AIF is 1 crore. There are various other nuances when it comes to the costing. PMSs will have different cost structure. There'll be management fee, there'll be performance fee, same is the case with AIF. And there are nuances on taxation as well. Out of the three products, mutual fund, PMS, and SIF, the best taxation appears in mutual fund, where there is no transaction level tax, unlike PMS. There is no fund house level tax, unlike an AIF. It is whenever a client gets into a scheme and gets out, he pays long term, short term. Now, this is where an SIF becomes the best of all the worlds possible. It is a strategy which can earn money on both sides of the market. SEBI has specifically allowed under specialized investment fund up to 25% of the AUM to be naked short. For instance, let's say I buy 20 stocks of 5 rupees each, that will make 100 rupees. This is called the long portfolio. These are all good quality companies, but I fear that there could be some major geopolitical tension, or there could be some major economic tension, whether in India or globally, and the markets are going to correct. If I were to hedge this portfolio, that will not get counted in naked short. What gets counted in naked shorts are specifically those companies which are short sold, so that when they go down, we make money in the downfall of the stocks. This is a specific category of strategy which is not allowed by SEBI for mutual funds. So when you talk about an SIF, you can make money on the long side, like typically what your mutual funds and PMSs do, and up to 25% of the portfolio, you can make money on the short side as well. Now, across my travel, there are 2-3 things that have come down to my notice as questions, and I'll take this opportunity to clarify for all the participants who are there. One view is that SIF deals into derivatives, and hence it's bound to be more risky. I would like to clarify here, as per SEBI regulation, SIFs cannot go beyond gross exposure of 100%. In other words, if I have 100 crore AUM given to an SIF scheme, the exposure to the market that the scheme can take is only 100 crores, which is what typically when a mutual fund would do. 100 crores of AUM could buy 100 crores of portfolio in the market. So derivatives, if derivatives gives you a risk when leverage is allowed. For example, if on 100 crore of AUM, there was a provision that we could create a 150 or 200 crore of portfolio, then that risk would have arisen. Leverage is not allowed in SIF. Gross exposure is capped at 100%, and hence that risk which people generally associate with derivatives is not there. That's point number one. Point number two. Across my conversations, I've also come across where partners have come back and said, while the strategy sounds good, but there's so much in if and but, so much extra that I have to give. What do I get in return? I'd like to clarify here when it comes to the taxation of the product, and I did touch upon it earlier. The taxation in an equity oriented SIF, if the manager makes the portfolio by keeping say 65% and more in delivery based cash equities, you would have the same taxation as you have in the mutual fund, where 1 year and beyond would be counted as long term for clients investment, less than 1 year would be called as short term, and as of today the long term capital gains in equity oriented products is 12 and a half, and less than a 1 year is 20%, so similar taxation. Then when it comes to about costing, irrespective whether it is a 1000 crore of an SIF or it is a 1000 crore of mutual fund, the cost structure remains just as is. Unlike many closed-ended funds that we used to see in mutual funds in the yesteryears, 3 year, 5 year closed-ended, SIFs in equities are allowed to be operated as both open-ended and interval. And this is an open-ended structure that Arthya Equity Long Short Fund is. Meaning you can come in and go out any day. The typical T+2 redemption cycle applies. So with this, I would now hand it over to Rajesh. I am sure all of us have joined to hear from the man in action, how he is going to maneuver the portfolio, how he will ensure that the long short strategy, as globally it is designed, that it should have meaningful participation in the markets on the upside, while when the market goes through a tough time, the downside should be curtailed. So that in effect, when you stay invested into a product like this for a minimum of one cycle, which typically we would say is a minimum period of 3 years, where you should see an index level 15 to 20% on the upside and also a correction of 10, 12, 15% on the downside, so that you realize that over a full cycle, the returns could be similar to what a long only product could offer. Yet, when the markets are correcting more than 10% and beyond, the downfall in this market during correction would be significantly lower. The objective with which this product is designed is to run that we should have a meaningful participation of about 70, 75, 80% on the upside and 30 to 40% on the downside. I must reaffirm the statement that is the objective that we are driving towards. With those words, I would request Rajesh to take it over from me and run us through the uh, designing of the product and how you intend to form portfolios given different market scenarios. Over to you, Rajesh.
Yeah, thanks a lot, Rizvi, and welcome everyone to this presentation. Again, on this side, just a few words about what long short strategy enables you for, and what typically are the basics of shorting. Because whenever one talks of shorting a stock, that is not a very common phenomena, because long short as a space has been relatively young in Indian markets, and most of it, whatever was there, it was available on the AIF3 side of the calculation. So within an AMC, we have not seen long short so far. Now markets, as everyone knows, whatever goes up, it must come down, and to that extent, market does have swings. Even you can say a structurally bull market like India have seen ups and downs and extremes on both the sides. So there are panic buys as well as panic sells. What long short strategy offers in such a scenario is to reduce the volatility, and whenever the market falls very sharply, your ability to short the market, your ability to cover your positions will help you reduce the volatility. And then how that is built into the product is what will come to in a short while. Now what is this strategy? What really is Arthaya long short equity fund about? It is more about delivering asymmetric return. Now, when I say asymmetric return, and using the ability of shorting to manage the volatility, what it means is that when the markets are going through deeper drawdowns, let's say it falls 12, 14, or 20%, then a long short strategy typically tries to reduce the fall in the NAV to around 30 to 40% of the total fall. So let's say the market has fallen 50%. So yes, then the fall of the strategy could be between 4.5 to maybe 6-7%, not beyond that. And that is done by deploying first, the ability to hedge your open positions as well as to short, so that from the price fall, your NAV benefits. Now, another advantage of any long short strategy is an expanded universe. I'll give you an example. Let's say a typical universe of any fund house could be 300 to 350 stocks. But if you look at it more closely, let's say one third or 40% of those stocks, which is roughly 121 140 stocks, are uh, characterized as non-investable stocks. So these are not attractive opportunities because something is wrong either on the governance side or on the opportunity side or growth side, uh, because of which the fund manager doesn't want to buy these stock. Now, at times, there is even an expectation that the price of these stocks could fall down from wherever it is. So, what does a long only fund manager uh, would do at such times is to avoid these stocks. Whereas in the shorting space, because you have the ability to short and make money out of falling prices, you can actually select few of the stocks from this universe where you expect the prices to fall down, then short those stocks and make money out of falling prices also. So that is about what capabilities does a long short strategy offer you or enable you for. Uh, a few things on shorting side, typically does it really mean that a stock has become very expensive? You go ahead and short it and wait for it whenever the price come down. It's not that basic and that simple. And so typically what one does is you have to keep scanning the environment, be it the global environment, even the domestic environment, how are various sectors behaving, and within that you have to keep spotting the opportunities where the fundamentals, the way the fundamentals are expected to shape up versus what is factored into the stock price. This starts getting disconnected, so you may have fundamentals are not really keeping up with the growth expectations, whereas your stock price is expecting that the growth will continue for 5, 8, or 10 years. And then so this is, let's say, a dichotomy which you observe, but that is not a sufficient condition for shorting. What you also need is a catalyst. So any cyclical stock, typically when you come to the peak of the cycle, this is very often observed that fundamentals or even the early indicators have started showing a picture that yes, the pace of growth may not remain where it is, whereas your fundamentals or your stock price is still reflecting continuation of that growth or continuation of that positive or strong outlook on the sector and the stock. And that is where you get these opportunities. uh, of course, I mean, the common sort of saying in the long short space is that you short three F's, which is frauds, fads, and failures. These are, of course, definitely are good opportunities, but they are not that often available in the market. So once in a while, you will also get some stock where there's a huge corporate governance issue or some kind of a business failure, or there could be some disruptive force. But these come quite less frequently. Another small word here: typically a pair trade kind of an approach is not followed. Pair trade is done where you do not have a very very strict directional call, on the absolute price movement, but you have a call on the relative price movement between same stocks which are in the same zone. Let's say two banks or two cement companies. That's where you try to do that kind of trade. That is not an approach which is followed here. So whenever we have a long or a short idea, it will be on an absolute basis, on its own merit. That if we expect the stock price to go up, we'll go and buy it or long it. If we expect the stock price to fall, we will go ahead and short it. So that's about what typically is done or what is looked at on the shorting side. I'd request Ashay to take us to slide number 8, I guess 9. Yes. So this is the slide which will tell us the broad operating landscape for the long short equity fund. Now, yes, I said that when the expect we expect the market to fall, uh, my objective becomes to restrict that fall. Now, how is it done? This is the broad or indicative roadmap for that. So the idea is that first we will assess and try to figure out what kind of market we are in, whether it's a bearish market, whether it's all out bullish market, or whether we expect it to be a flattish market. And accordingly, the total or the net exposure that we have on the market will be adjusted. So let's say I expect a bearish market where either the stock price will remain here, or there is a high probability that the market would correct very sharply. In that case, the fund will not have a high exposure. I will not be sitting at 80 or 90% net exposure when I expect the market to go down. I have the ability and I have the flexibility with me to reduce my exposure to as low as 0%. So let's say the indicative range of net exposure which we have put here is around 0 to 40%. Typically, I would say in a bearish market also, 20-25% exposure is good enough, unless you end up into a risk off environment, which we have seen typically since the end of February to almost the entire March. We have seen a risk off environment where there is an indiscriminate selling in the market. So whether you have a good stock or something which is very reasonable in terms of I'd say valuation as well as outlook, good strong companies, blue chips, it will get sold off. Why? Because the environment is risk off and nobody wants to hold any stocks. So this is typically coming from FIs where they have that indiscriminate selling because they want to exit the market. Flip this and we come to a bullish market. In case of a bullish market, I have the flexibility to become a long only fund, because objective will change from preserving the capital which I was having during the bearish market to trying to maximize the gain from the market. So I can become aggressive, try to get more out of the market and make the most of it, as they say it. During that period, it is obvious that SEBI has capped my gross exposure at 100. So if I want to increase my longs, I will have to reduce the shorts. Otherwise, there's no way that my net long will be higher if I keep the shorts in the system. So these two become, sort of extremes. There are or sort of two ends of the phases of the market. The extremes within this, on the bearish side, we have seen what happens when we have a risk off environment. On the bullish side, there could be a risk on environment where just like you have indiscriminate selling during risk off, you may end up having indiscriminate buying during risk on. And in such case, you need not keep any shorts in the system, because whatever you short, it will tend to come up. In fact, the worse the short, the more will be the up move because of short covering and that kind of phenomena. In the flat market, like I have highlighted earlier, the fund has the ability to make money even from declining prices. So my canvas is expanded. I even look for shorting opportunities, which will be well rewarded by the market. Now, broadly, this is how the framework within which the fund will be operated, and the way or the guiding philosophy will be that if the market is expected to fall, or if there is not a conducive environment to make money, or the risk reward is not really favorable to remain long in the market, I will reduce the exposure. And as soon as the market turns around, bottoms out, or things really settle down and improve, I can always come back and try to achieve most maximum gain during that period. So this explains how we are placing this particular fund. Now, I think we still have 5 to 8 minutes when I'll give it back to Rizvi and request him to explain how exactly you place this fund, because the obvious question we keep getting is that there are already 45 AMCs, you have bouquet of products. In equity also there are different classes of products. You have balance funds, you have debt funds. How and where do you make space for SIF? What is the need? And then when we reach out to our clients, how do we position this product? That's maybe we can cover it quickly and have maximum time for Q&A after that. Thanks a lot.
Thank you, Rajesh. Before I move on to covering the positioning part of it, I would request Ashay to go to that slide on the last page where we are talking about asymmetric returns. The next one, the last one, annexure. Now, this is a slide which basically talks about asymmetric return. Before I begin explaining this, we just wanted to give you a clarity. This is a slide which is taken for Nifty 200 as an index, the data point. Now, we all understand the long only investing, which is most of the time in long only investing, the fund managers are fully invested, if not 100%, between 95 to 97%, largely. During times of stress, the cash component does go up, but not significantly. So, if I were to give you a ballpark answer, at all points in time, 94, 95% in long only equity funds is invested. That is why those funds rise with the market. When the markets are rising, they rise perhaps 0.5% to 1% more. And when the markets are falling, those funds also fall almost as much, perhaps 0.5%, 1% less. And this data is very easily proven if you were to look at any equity mutual fund category over a 3-year and beyond kind of a period. The respective index of that category and the category average returns will be largely similar. There will be some alpha of 25-50 basis points. The idea is not to say one category is better than the other. The idea here we are talking about is just to show how asymmetric return functions. So hence we've taken a data. This data is between June of 21 to March of 26, which is roughly about 4 years and 9 months. In this period, the absolute return of Nifty 200 is 58%, the standard deviation is 28%, and the Sharpe ratio is 2.1. Now, if you see this data and slice and dice it for every 10% up and every 10% down, you'll realize that between 30th June 21 and 29th October 21, the index gave a plus 13% return. Similarly, 29th October 21 to 30th June 22, the index gave a minus 10% return, right? And that's how over the 4 years, 9 months, you got 58%. But there have been periods when the returns have been plus 13, minus 10, so on and so forth. Now, in a 50-50 strategy, what happens is you capture only half of the upside and half of the downside. So you will realize that when the markets are going up by 13%, it actually would be something like a 12.7, 12.8%, which has rounded off itself to 13% to be a single digit. Now, when you take a half of it, it's about 6%, right? So you participate only half on the upside, half on the downside. And what you see is your returns over the same period when Nifty 100% up and down has given you a 58% return. The 50% up and down has given you a 32% return. Consequently, because it is 50-50, the standard deviation is half, your Sharpe ratio is slightly better. Now, the moment you move towards the left side, you are talking about an asymmetric return, where the participation on the upside is slightly higher and the participation on the downside is slightly lower than 50%. So in the second column, we have second from the right, we have captured a 60% plus and a 40% minus. So when the markets have gone up roughly 13%, 60% of that 13% is 8%, right? When the markets have gone down by 10%, 40% of that 10% is minus 4, so on and so forth. Now you would realize that the returns better than 50-50, and almost closer to the entire 100 going up and entire 100 coming down. Where the return is 58%, here the return is 53%. The moment you move towards 65-35, that you capture the 65% of the upside and 35% on the downside, you see the returns in this case are surpassing. The we can move left to 70-30 and 80-20 and 90-10. The objective is not to tell you the return on this particular slide. The objective of this slide is to tell you that in an asymmetric return capturing mechanism, you don't have a requirement to capture full 100% on the upside. I'll give you a very simple example. Let's say the current war situation that has happened from 27th of Feb to the peak of the war, when the markets were at the lowest, the market would have fallen roughly about 13 odd percent. In other words, 100 had become 87. And the equity long short category, whatever 3-4 products that are available, would have fallen roughly about 5.5-6%, right? Let's say 6.5%. So in one case, 100 has become 87. In another case, 100 has become, say, 93.5. Now, for 93.5 to become 100 back, you only need an 8% odd kind of a return. And for 87 to go back to 100, you need roughly like a 16-17% kind of a return. The idea that we want to have here clarified to people is, in a uprising market, even if the long only captures 70% of the market, markets have gone up 20% and you have been only able to capture 14. Still, because you fall lesser on the downside, you can expect a return which is broadly similar to what your, in this category, what your flexi cap category kind of a return would be. Whatever that number is, 10%, 15%, only time can tell what that number is over a 3-5 year period. But this strategy would give you similar to that number, albeit with a very, very low volatility. And that is where it gives you a better risk adjusted return. Now, this leads me to the question that Rajesh asked me to address clearly. Where do I place this in a client's portfolio? One, this is a new asset class which has emerged, and we have all seen how PMSs has evolved, how AIFs have evolved over the last 15 years. As the clients graduate from, SIPs to lump sum, from smaller portfolios to larger portfolios, there is an inherent need for them to try newer products. So this is also an allocation. But if I have to put a positioning to this product is very suitable for all those customers, whichever age bracket that they may be in, who have this inherent desire that they want to participate fully in the market when the markets are on an upswing. But when the markets go down, many of them, particularly the clients in the age bracket of late 40s to mid 50s, who are planning for the next retirement kind of scenario over a 7-8 period, they are one coherent set of people who get very vulnerable when the markets are falling. And many of them tend to move out of the market because they get feared that, things are getting out of control, markets may fall further, I may lose my capital more, and they go out. And they generally return to the market when everything has turned positive, markets have crossed the previous highs, and that's when they come in. SIF, equity SIF is a product that's suitable to this category of investor, because over a 3 to 5 year period, it is designed with an objective to deliver similar returns to what a flexi cap long only strategy should give you, with a risk which is very, very low when the markets are on the downside. So this is a clear positioning in my mind for equity oriented SIFs. Being equity, we do not ask clients to come in for a period of less than 3 years. The longer the horizon, the better it is, because for markets to go through the cycles of up and down, plus 15-20% on the upside, minus 10-12% on the downside, these cycles take time. It is expected over a 5-year period, you could see perhaps 2 odd cycle or perhaps 3 cycle. And that is when you will realize the benefit of a product like SI. So that was the point that I wanted to cover up. We are happy. We could, if Rajesh wants to add some closing points, otherwise, Ashay, we can open up floor for questions. Both Rajesh and I are here to answer those.
Yeah, I think Rizvi summed it up quite well in terms of where exactly we want to position this product. And see, the only thing is SIF is a new category. Long short strategies have not been there in India for this is the early stage of these strategies. However, one comforting factor is that long short as an industry globally has been in existence for decades, at least since late 50s or early 60s, and that puts us in a slightly more comfortable zone that yes, a lot of things have already been tried and tested, and this particular strategy, which is risk adjusted return strategy, or deploying your shorting ability to curtail the downside or to preserve the capital when markets are negatively positioned. This has been there, in the global space. So there has been, I would say, enough kind of track record for these kind of strategies. Uh, so I think with that, I would stop here and welcome all the questions. Like I said, this is a completely new uh, area for a lot of us in the distribution and manufacturing community. So whichever questions you have, please feel free to ask. We'll try to address all of them.
Thanks, Rajesh. Thanks, Rizvi. I'm just stopping this share for now. If you guys need this presentation again, we can get it up and on. So there are a few questions. Some of them are really interesting. So I'll just start one with so what risk should investor be aware while he's coming into an SIF? Yeah. So that's the question.
I'll take this up. So the risk that an investor should aware is like in any other investing, that the strategy should live to its mandate. That is one. The market risk is always applicable. Second, the third risk that one should be aware of, and which in fact this question gives me an opportunity to clarify. One more question that I have often received while meeting people in person is that since this is long short, you could go wrong on both sides. You know, what you have sold, short sold, thinking it will come down, would actually go up and you will make losses. And what you bought, thinking that it will go up, could actually go down and you will get it wrong. So let me clarify the third part once. Let's say you give money to a long only manager 100 rupees and you give money to a long short manager 100 rupees. For the sake of this explanation, let's assume both of them are going to put in 20 stocks each, 5 rupees, right? So the long only will put 20 stocks by buying 5 rupees each. The long short manager will buy 15 stocks for 5 rupees each and will sell 5 stocks of 5 rupees to make it 20. 25% is my shorting ability. So 5 into 5 is 25. Those are the stocks I have sold. And 15 into 5, 75 is the long position. Now the question is, I could go wrong on both ways. Well, that's right. There's no problem. One can go wrong in anything. But look at it from a position point of view. The long position is 15. The short position is 5. I have got 2 of my long positions wrong. I have got 2 of my short positions wrong. Out of 24 are wrong. But couldn't that be the case with a long only manager? That he has bought 20 of his stocks and he has got 4 wrong. What I'm trying to equate here is there is no extra risk. If there is an ability of a fund manager to go wrong on the short side, to go wrong on the long side in a long short, the same could happen in a long only product also with 4 positions. So idea is to just make clarity that it doesn't matter whether it is long or short. Mistakes can happen anywhere. The other myth which is related to this is, well, you buy something for 100 rupees in a long position. How much value would you lose? 100 could possibly become theoretically 0, right? But when you short sell something at 100 rupees, thinking it will go down to 70, it actually doesn't go down and it can go up. And how much can it go up? 100 can become 200, 500,000. It could be any number. So shorting has unlimited risk. Well, technically, yes. But when we buy something, a stock for 100 rupees, and it starts declining in its value, do we actually wait for it to become 0? or we start cutting our positions at say 90 or 85 or 80, that's when we try and exit that stock completely. Similarly, when you short sell something thinking it will go down and it actually reverses up, that could possibly happen. But if that happens, you will not let that 100 rupees stock which you have shorted to become 200 or 300 at maybe 115, 120. See, you would square off the position. Whether there is a long position in terms of buying a stock or short position in terms of selling a stock, there is going to be a reason or a thesis why we have done it. And the moment that thesis goes bust, the thesis is proven wrong, then you cut your position, book losses, and move out. You don't let it remain forever. Rajesh would also talk and tell you that we have strong risk management principles in place. Every position, be it long or short, there are internal rules and regulations and numbers, how much losses can we absorb on each of those. And because this is a product where the key responsibility area, the KRA, is to ensure that the downside is protected as much as possible. It can never be 100% protected. As much as it is humanly possible, we would try without giving any upside of the market. The idea is you have to have your positions and your risk management well in place so that beyond that tolerance of risk that the fund house has decided that the fund manager is comfortable with, you exit. So these are some of the risks that comes to my mind. But if participants have any particular question on a particular risk, we'd be happy to answer that.
Thanks, Rizvi. We have another question connected to what we have already spoken, though, but then still it puts the question is relevant from an investor's perspective as well as a distributor's perspective. Now, we have answered in a way that SIF doesn't mean extremely high risk because of the derivative component compared to mutual funds. But from an investor's perspective, what the question is like, is it only so if the returns are going to be similar to a mutual fund, what is there for him to take back from this investment? That is from an investor's perspective and from a broker's perspective, why he should be selling uh, this as a product, how it will complement his existing portfolio of his investor, because then he's concluding that it is risky again, and the commission structures may be something similar to your mutual funds.
Let me take both the questions straight away. So let's talk from the investor's perspective. Okay. Now, from an investor's perspective, are you paying anything extra in terms of taxation between a mutual fund and a SIF? The answer is no. It's the same mutual fund taxation structure. Are you paying anything extra in terms of cost? No, it is the same mutual fund cost structure. Are you taking anything extra in terms of risk? Well, yes, derivatives allow us to maneuver the portfolio in terms of bearish market to help make it an arbitrage strategy, in terms of bullish market to make it a long only product, gives flexibility. But does it add any leverage risk? The answer is no. Does it require you to stay invested anything more than what is a suggested horizon for a long only equity product? The answer is no. So there is nothing extra that the client has to pay. But what extra does he get? A similar to a flexi cap kind of a return. Of course, there is a possibility of making an alpha over that. But if the alpha can be positive, there could be times when alpha could be negative also. That's why, promising a higher return is not what one should look at. But if one says that over a 5-year period, you expect a similar kind of return to a flexi cap fund, but in the interim, if you have a 15-20% fall and you should expect a 40 to 50% of that fall in your portfolio, that gives you the comfort, particularly in the times of the downturn when people get jittery, because each time markets correct, they have a different reason. At least in my career, I can count 3, 4, 5 reasons. Once it was the global financial crisis, once in a 70-year event, once it was, breakup of Britain going out of Eurozone. It was almost the beginning of so-called multilateralism. Then you saw COVID, which is a once in a 100-year event. These were all profound events they all shook the belief of even some of the staunchest investors. In the hindsight, we are all wiser. Now we all know what those risks were. So the new risk which will come will manifest itself in investors get many of them by exiting, and they lose on the opportunity of creating wealth. This is a product category which will sustain you in that time. So this is an answer for the client. Now, when it comes to the distributor community, particularly talking about the commission, our industry is perhaps one of the most transparent in India. Everybody knows everything. If I'm going to earn the same commission that I'm earning on a mutual fund, the payouts ought to be similar. I mean, if there is, where will the asset management company pay extra from? While we are all know it's an industry practice, the pricing during NFOs, the pricing thereafter, these are all differing. These are industry practices. And we can assure that we are a part of the industry. We follow industry practices.
I
Yeah,
think,
thanks, Rizvi. I
Ashay,
think
I'll just touch upon this, subject of risk in little more detail, because we keep getting this very often. Uh, See, what Rizvi has told in the beginning, where exactly is the perception of risk when we say derivatives? It appears very risky. And why it appears risky is because there is a large leverage, which is, let's say, if I have 100 crore AUM, technically without any restrictions, I can create a 400 crore portfolio with that. I'll give that 100 crores as margin to the custodian, and I can create positions in future and option or derivative market. What will happen is, if there is, let's say, that 400 crore makes a gain of 10%, I am making 40 crore on the 400 crore, but on my capital of 100, I am making a 40% gain. Similarly, when I'm losing 10% on 400 crore, I'm losing 40 crore. But on my capital, I'm losing 40%. So the concept of leverage, what it does is it amplifies your returns as well as your losses. And that is the large risk of, derivatives. As explained earlier, what SEBI has done is they have restricted the leverage to 100%. So if with 100 crore AUM, I cannot build positions, active positions in equity market beyond 100 crores worth. This is the notional value of position. So because of that, that perception of risk, you know, which is coming from leverage gets eliminated. And then the second part is, of course, we are dealing with some instruments like shorting a future, where your technically your loss or theoretically your loss can be unlimited. Now that is the part I especially want to touch upon, because see, what happens is, once a portfolio is constructed, let's say you ascertain what is the phase in the market, you could be, let's say, bearish, you want to keep your net exposure and gross exposure at a certain limit, you do all that and you create the portfolio. Then, on a regular basis, I would say the most critical activity is risk management. Now, what is that and where does it come from? It comes from the simple fact that being a long short fund, having the capability to short, there is a limit to which I can fall along with a falling market, or I can fall when my calls go wrong. And because of that, risk management is far more paramount. And there are various ways of managing the risk. Let's say, when there's no strict or defined stop loss per se, but yes, when my thesis goes wrong on any investment, be it long or short, I need to be vigilant to it, I need to be responding to it in terms of changing the position size. Second thing is, inherently, when I know that certain stocks, let's say, which are very high beta stocks, I know that these stocks can move up 5 or 8% or come down 5 or 8% without any clear or visible event backing it. So I know that in such an extreme volatile stock, I cannot be putting a higher weightage or higher allocation. So I will not keep a very high allocation for a stock which is, let's say, having a beta of 2 or 2.5. Why? Because I know that if this position backfires, it will hurt my NAV much more if the weight is high. So how do you manage? Do you not take any exposure to that position? No, we'll definitely take, because we are in the business of managing the risk, not avoiding it. So you take the exposure, but you limit it in such a way so that even if the position backfires, the hit on your enemy is not that high. In simple words, let's say if there is a high beta stock, I have a choice. I can keep 6 or 7% weight. Let's say it's a high conviction idea, or because it's high beta, I will restrict the weight to 1.5 2%, or maybe 2.5%. I would say this portfolio is designed in such a way that it will choose the second path, that if the stock is very high beta, or if there's a chance that it will move against me with a high magnitude, then I will restrict the weight so that I am not getting hit disproportionately when things go wrong. And that is a continuous activity. It's that is the way every stock position is evaluated. That is the way every stock position is, on the way you have checks and balances. If you earn a certain return, you know when to take it off, or what are the odds against you. And it is continuous evaluation of risk reward at the market level, at the sector level, and at the stock level, that goes into building the portfolio.
Yeah, thanks, Rajesh. I'm just clubbing a couple of questions. So what the one part, the first part of the question is like, how is this naked short position will be adjusted if there is a if you are seeing a rising market, and how often the portfolio might would get rebalanced in either of the cases. It's either going up or slash going down, but is there a set frequency for that? Now the connecting question is, what if the shorting goes wrong for some part of it? uh, it'll create a damage to the portfolio. So typically, will it be such that it'll take longer time to recoup and then start rebuilding on the return part? So these are the two connecting questions: how you will manage the overall risk. Though you have already spoken about risk in detail, but if you can just have a quick couple of liners on these two particular questions and sum it up there.
Yeah, I just lost the track of the first one. Can you please repeat the very first part of
So
it?
first part was, in a rising market, how would the naked short position will be taken, and how often it will be rebalanced.
Correct.
Aisha,
Yeah.
can you
So
put you that slide up so that we can talk? The market slide, Rajesh.
Okay, hold on a second.
We have our positioning there now.
That is slide number.
Yeah, no, the slide number 8 or 9, Rajesh, the
Sure.
market
yeah,
scenario.
Hold on.
This
yeah.
one.
Yes, Rajesh, go ahead.
Yeah, so this, it's a very, very interesting and pertinent question. See, whenever any shorting is done, or any trade is taken for that matter, because I told if the position goes against us and starts hitting the enemy, it's not a case where you take the position and buy it, fill it, shut it, and forget it. It's never the way. You have to keep evaluating if the position moves against you. Normally, it doesn't happen in vacuum. There is a good reason, and if that reason is really, so to say, puncturing your thesis why you invested, then you need to act on it. And that is why it appears that yes, the move out could also be quite quick. Second part, in a rising market, what if your shorted position start moving up? Yes, that is definitely a risk. And there are two parts to this. One is, let's say, when we are in a bullish phase. Now we have seen that India is, like I said, it's a structural bull market. But does it mean that we did not have any stocks will fail in price? Or even, let's say, I'll give you two examples. There are two points in time when market was 26,300 or plus minus. These 2 points were 18 months apart. Okay, sometime in September 24 and sometime in February of 26. Now, although market was flat, what had happened is your auto index was up around 22% during this phase. IT index was down by 20%. So what I'm trying to put across is that, the exact market movement is one thing, but there are always sectors and stocks which are positioned differently. So although market is bullish, it doesn't mean that everything and all and everything is really bullish. There are some weaker spots in the market. And what is the risk on that? The risk on that is something like a short squeeze. So let's say there is something which is weaker and it has already fallen, and there is a very, very high, let's say, short OI on that name. That what it means in simple language is that all the position makers have a short position on that stock, and some trigger comes where the market really bounces the other way around. Then there will be a short squeeze. There will be everybody will start and try and cover up those shorts. But all these things are, these are essentially monitored even before the trade is taken or after the trade is taken on a continuous basis. So if I'm aware that something which is extremely heavily shorted across the street, that means in simple words the open interest of short in that position is very high. I will either have a very, very low weight in that, or I will also have, let's say, counter position. Let's say I have a short in the system and there is a result coming up for that company. There are means of covering it. So only during the result period I can have some calls also purchased, so that if there is a short covering, calls will provide me some support till the time I move out of that position. So all these are, I would say, these are all risk management sort of practices which are very regularly followed. Because again, I point out the same thing. If there is anything which is central to the philosophy, it is your risk management, how you manage the risk at the portfolio level. So I'd say that would broadly answer, uh,
Thanks, Rajesh. One specific question for you, Rajesh,
yeah.
is can you describe your role while you were part of the ITI Long Short Fund as a fund manager? And connecting question is like, what is the max net position you will be taking in case of Arthaya SIF? And yeah, the last part of the question is like, is there sufficient capability in-house to identify good shorting ideas?
Yeah, thanks. So, coming to my ITI experience, I joined ITI Long Short Fund in 2017 as a fund manager. The fund came into existence in early 2018, and since then, for around 6.5 years, I managed that fund as a fund manager. So that was, the role. That was my role at ITI. Of course, I mean, the other team, we had CIO, we have other people also in the team, and the track record of that particular fund is out there in the public domain. Uh, that is one part. Sorry, what was the second question?
The second question, Rajesh, is the second part of the same question is, uh, do we have in-house capability to identify good shorting ideas, given our smaller size in terms of the investment team, and maybe the research analyst could be in a single digit number.
Yes. So, let me put it this way. The SIF is part of AMC team itself. So it's not a watertight, or, there are no Chinese wall between SIF and the AMC team. Like it was, let's say, in an AIF3 structure where, AIF3 team is completely separate. So yes, to that extent, I would say we have enough capabilities. We have a team of almost 11 people in the investments. They're covering different sectors. Of course, I mean, large part of it is geared up for long only. But if you ask me, for identifying shorting ideas, that is a specific skill. And to that extent, not there are not a large number of people who are available as such. Now, where it helps is, see, one person typically, risk management is not an activity which can be shared across different people. So if there is one fund or two fund, there needs to be only one person who is managing that fund, because risk management is far more critical. What I'm doing in one position and what I'm doing in other position, how they are balancing each other out, all that activity needs to be checked and needs to be going through only a single person. So to that extent, which are the shorts which I need to take, which are the areas where I need to look for short, which are the areas which will balance in case those shorts go wrong. All these things it is always better if it is, done by a single person. And let's say I am that person doing it. So what do I need? I need enough research support. And of course, I mean, just to tell you further that it's not that, it's a single person team. We have, we are rolling out offers, and the team, there will be enough sizable team of at least 2 to 3 people very shortly. And on the research support side, I do have, a team of almost 11 people, which is our AMC long only team.
Thanks, Rajesh. Uh, One question which is, so there's a second last question. I'll just put it from an investor's perspective. Should a distributor be seeing this particular SIF as a strategy only for the risk adjusted return, or it can be an alpha generating prospect as well? So if I have to answer this particular question, I may say, uh, if the investor, if you make the investor stay for multiple cycles, there is a very high probability of it to generate better alpha compared to a mutual fund. I'm again repeating myself. A better probability as you stay longer, because what Rizvi in his earlier part said, that you should be a stickler to at least 3 years, which is one cycle. Assume that you end up getting into a 2 or 3 cycle, then in that case, that helps the probability of generating an alpha. Any thought on that, Rizvi?
Ashay, I would give you a mathematical number. Hopefully, people can visualize. Okay. You have 100 rupees each, one to a long short, one to a long only. Okay. And the markets go up 10%, or let's say 20%. Okay. So the long only goes to 120, and the long short is able to capture only 70% of it. So it goes to 114. Now from 120, the markets correct by say 10%. It comes down to 108. Long short in a 10% correction, let's assume the objective of 70/40 is achieved. That on the upside you capture only 70%, on the downside you capture only 40%. You are at 114 and you have to come down by 40. Markets have fallen at 10%, you're coming down by 4%. That's roughly like 5 rupees 60 paisa. Right? Yeah, 5 rupees 60 paisa. So you're already at 108.4. Thereafter, because your base is higher, the next 20% the market goes up. 108 becomes whatever, 130. Right? Your 108.6 only goes 70%. And again, there is a 10% fall. So I'm just substantiating by numbers to what you said. If you stay over multiple cycles of ups and downs, and the fund manager's objective of participating minimum 70 on the upside and about 40 on the downside is achieved, there is a strong possibility of alpha. Why we have consciously not gone ahead and spoken too much of alpha is, for our participants who are there on the call, one analogy I'll give. 10 years back, if somebody had asked you what the allocation of gold in the portfolio should be, one would have answered saying 5 to 7% as an inflation hedge. The same question today has automatically become 15%, right? 12 to 15%. Because gold has given the kind of return it has given over the last 15, 17 years. So 3 to 5 years hence, when the industry's philosophy of participating 70-80% on the upside, 30-40% on the downside to give asymmetrical return has already been proven, then talking about alpha will become a lot more easier because you'll have data backing it. So a long short answer short, yes, alpha is possible to generate, but let's keep the expectation around mutual fund so that when you get a alpha of 1.5% over a 3-5 year period over what the flexi cap would give, one should feel happy about it.
And I'll
Thanks,
just
Rizvi.
add one more thing, Ashay.
Yeah.
See, this is an important question because, and also relating to one more risk part of it, and that risk is more for the advisors. See, what happens is, if you look at the way the product is designed, when the in the up leg, when the market is rising, the product is not designed to outperform. So it is not designed so that you chase a rising market, you infuse more risk in the portfolio, and if any accident happens, you will have to pay for it. So the point is, the trailing return basis, you know, that so-called alpha, it will look much different when the market is at the peak. When you are at the peak, long short funds, it will appear that are underperforming the corresponding long only counterpart or even the benchmark for that matter. But when you are at the bottom, it will appear like the long short fund is doing phenomenally well. And if you run any sort of mathematical expression and try and figure out as to what is happening at the peak and what is happening at the trough, and that is where one needs to be having the expectations properly aligned. That if you compare only the rising market part, that market, let's say, bottoms out here and it goes to 30,000. If you compare only that part, that it got bottomed out here and went to 30,000, it will appear like the fund is behind the index or behind the benchmark or behind the long only counterpart. But subsequently, when the fall happens, and let's say from 30,000 it comes back and let's say settles at 26 or whichever number that it is, at that point in the fall, given the outperformance of long short strategy, which predominantly comes in the fall, it will appear like the long short strategy is miles ahead of the benchmark or even the long only counterpart, only in the fall part of it. And that is where the difference is, that I cannot isolate a rise and compare it with benchmark or compare it with the long only fund. I cannot isolate only the fall and compare it, because in the rise I will look very bad, in the fall I will look very good. But when we look at the whole cycle, let's say typically over a 3 or 5 year period, when you have seen significant upside followed by a significant downside, and over that period it will come out that yes, the returns are comparable. Like what Rizvi mentioned, typically there is alpha, but we are conservative. We do not want to build wrong expectations. I do not want to say that if flexi cap or BSC 200 gives me a certain return, I will be much better than that. No, we are saying our returns will be close to that. The differentiation that we are trying to make is that my Sharpe ratio will be far, far superior. That means my volatility will be much lower. In simple words, it means that when the market is cracking, enemy will not crack as badly. Your clients will remain in the system. There will be no urge by the client to, redeem and move out of it. So these are the two parts. And in fact, if you ask me what is sort of risk in the product, it is the risk of having, wrong expectations which are set in. So let's say in the early days of long short, it's just a different example I want to check in, that when we used to discuss that yes, we are running a long short fund, the expectation even used to be कि अगर बाजार 10% गिर गया तो आप तो 4-5% ऊपर होंगे. But just to tell you, these kind of structures exist in the global market. They are called as short only funds. This is not a short only fund which will rise when the market falls. This is a long short fund which will also fall when the market falls, but it will fall in a limited way or in a measured way. So I think setting the expectations is one thing which, even the advisors need to be a bit careful. Maybe if Rizvi can add, and then we can have a closing comment, because I think we've reached the time also.
Yeah, no,
Yeah.
you've covered it very well, Rajesh. I think we can just have the closing comment, Rasha.
Before that, one last question, Rizvi. I'm so sorry,
Yeah, sure,
but
sure.
that's a relevant one.
Hmm.
Is like, how do we differentiate from the other competitors available in the market today, and what concrete support we are going to support, we will be providing to the advisors in a smaller market. So
I
I
think
think
Rizvi
it
is
was
the
a
relevant person to answer
relevant
this.
person and a relevant question. So I thought, let me take this question as the last question.
Okay, so the second part of the question I understood. Please repeat the first part.
First one is, how do we differentiate Artha SIF with the existing players in the market?
Yeah. So, this is a question also which we have got many a time. See, when it comes to the long only, see, I have given a lot of examples of long only just to get people comfortable that this is also a part of investing, which is called long short, globally been there for long. though in India and in mass market, we are now realizing of it. There also, largely your investing style is either growth or value and a mixture of that, right? So in each category of mutual fund, you will have 20, 30, 35 players with, in fact, in mutual funds, the allocations and the number of stocks and things have been even more straitjacketed. Still, we see there is a delivery of return which is different for different funds. So similarly, even in a long shot, the philosophy remains risk-adjusted return. The philosophy remains asymmetric participation in the market. The philosophy remains protecting your capital on the downside. Yet execution of different people is different. And particularly for advisors, you should also pay a lot of attention to different funds and see where are the fund managers who've come with the long short experience. Because unlike long only, this market requires agility. Because markets can move up and down, you're constantly on the watch that you should try and participate as much as possible in the upside, still try and protect as much on the downside as possible. You may have to move and take swift action. Those things are possible when the portfolio manager has already done it in the past. So that's my answer to the first part of the question. Now, second part of the question is a little more tricky, Ashay, to answer. While money, the color of the money is same, we welcome our distribution partners and clients to work for us everywhere. It is our endeavor to reach out to all of you at all places, but practically in a 15-day NFO, it may not be possible to reach everywhere. Having said that, our teams have been well equipped to kind of go and talk, and at least in the top 20 cities, I have personally been along with our own teams and met quite a few distributors. Wherever support needed in terms of doing, a Zoom meeting for clients. In some cities, I'm present and Rajesh is present in person. We'd be happy to accommodate. I just want to mention one thing. This is a beginning of a category. It's NFO is just a starting point of gathering money in a fund. It is not a destination in itself. As I keep telling to my own team that we've just started the journey. The journey is long. Uh, you know, Market is all about dreaming. I dream that SIF as a category over the next 5 years will become formidable. I don't want to put a number saying 50% of the mutual fund or not, but it will be formidable. It will not be something that people will be able to say, this is a category I don't want for my clients. Eventually, over the next 5 years, every client worth his money of 30, 40, 50 lakhs will have an SIF allocation for sure, which means collectively as an industry, we have to work hard. So may not be 15 days NFO where we are present everywhere, but our support is there. We'll reach out to each one of you in all the markets possible. Top-down approach in this aspect is generally used. So we have already gone ahead and met clients and distribution partners in all the top cities. And we begin with the tier 2 cities very soon. So I know the
Just to
second part
add
of
it
the
on,
answer is not very comforting as people would expect it right now. It's a work in progress that we will continue.
and I'll just add one small code. In fact, it's something which Rizvi has been telling all our internal members, as much as we have traveled, that at our end, this NFO is going on for next 6 months. So yes, I mean, for you, of course, there's a limit of 15 days. For internally, we are geared up that yes, we need to reach out to people, and it is too much on the plate to be covered within 2 or 3 or 4 weeks. So that process will continue much beyond the NFO closing timelines.
And since it's related to the question you asked, Ashay, many of the participants on the call would have been participants of our NISM 13 training. We've conducted over 40 odd trainings, covered more than 1,000 distribution partners across India.
Surely.
We shall continue to do that in future as well. So as and when those of you who are on the call who may have not cleared, or you may have your friends, colleagues, children who would want to do these, reach out to our local teams and give your expression of interest that you would like to have that NISM 13 training to be done. Once we have a sizable number of people in any city, it it's almost assured that we will do it.
Thanks, SV. I think we have completed all the questions, relevant questions that we asked. Any closing remark, if any, or else we conclude the call.
So, thank you so much, participants, for being on this call. We are all going to be, as industry participants, create a historic category, not just in terms of our NFO. SIF is a product that's suited for one and all clients. Some may begin sooner, some may begin later, but eventually everybody is going to have it. It's a chance that we get to connect to our clients and give them something where risk adjusted returns are being made, and we shall all be in it together, and we will cross the journey together. We have our NFO beginning on the 4th of May till the 18th of May. And of course, we would expect each one of you to participate in our NFO wherever possible that we can assist you with. Many of you would be having access to all of us directly. Please reach out. Otherwise, reach out to our local teams. As much as humanly is possible, we will assist you. Thank you so much.
Thank you, participants,
So
and
much,
have
everyone.
a good evening.
Bye.